we'll dive into one of the most crucial aspects of financial risk management, market risk management. Whether you're preparing for exams like RBI Grade B or looking to strengthen your foundation in finance, this topic is a must-know. Let's begin. What is market risk management really about? Market risk refers to the possibility of losses due to changes in market prices like interest rates, exchange rates, stock prices, and commodity prices. Managing this risk is essential for banks, financial institutions, and even corporations dealing with financial instruments. Market risk management is all about answering 4 key questions. What are the risks? What is the quantum of risk? How can we monitor and control the risk? Can the risk be reduced? How do we identify market risks? The first step is risk identification. We need to recognize potential sources of market risk. These can come from various directions: interest rate fluctuations, foreign currency movements, changes in stock prices, and commodity price volatility. Institutions must identify risks across all financial instruments they deal with: bonds, equities, derivatives, and more. Without proper identification, no further action can be meaningful. How do we measure the amount of risk we are exposed to? Once we know the sources, the next step is risk measurement. This involves quantifying how much risk we are actually exposed to. Various tools are used for this. Value at risk, or VAR, which gives a potential loss estimate under normal market conditions. Duration and convexity, particularly for interest rate-sensitive portfolios. Sensitivity analysis, which helps us understand how small changes in inputs affect the value. Stress testing, where we simulate extreme market conditions to see how much damage could occur. These tools help institutions estimate the potential impact of market movements on both earnings and capital. How is risk monitored and controlled on a daily basis? Risk measurement isn't enough. It has to be continuously monitored and controlled. This involves setting limits and triggers, such as stop-loss levels or maximum value at risk levels. Positions and exposures are tracked daily. Any exceptions, like a breach in limits, must be reported and analyzed. This is often referred to as exception reporting and variance analysis. It ensures discipline and quick reaction to emerging risks. Can market risk be reduced or avoided? While we can't completely eliminate market risk, it can definitely be reduced or mitigated. Risk mitigation techniques include hedging through instruments like forwards, options, futures, and swaps. Matching assets and liabilities to neutralize interest rate or currency risks. Diversifying the portfolio to avoid concentration in one asset class or sector. Reducing overexposure to any single market or financial instrument. These strategies don't remove the risk entirely, but they help in managing and minimizing potential losses. What makes a market risk management framework effective? An effective framework is built on several pillars. First, there must be a strong mechanism for identifying risks. Second, there must be clear limits and triggers set in advance. Third, continuous monitoring is a must. Fourth, analytical models should be used to measure and assess risk regularly. Fifth, the results of monitoring must be reported in a timely manner to decision makers. And finally, the organization must have a clear structure and defined roles for managing market risk. One crucial point to remember is this: unlike credit risk, market risk cannot be priced. That's because prices of financial instruments are determined by external market forces, demand, supply, global trends, and investor sentiment. So, the focus must be on measuring, monitoring, and managing, not pricing. If you found this explanation helpful, don't forget to like the video, subscribe to the channel, and share it.